in every market cycle, in any market, there are opportunities. In 2024, where do you think the pockets of opportunity will be?
There it is.
That's what you meant to say.
Yeah, that's great.
I would actually be a little bit contrarian and say a lot of these offices that are located in top 5 gateway cities, they're probably getting to a point where that cost basis on entry is low enough that you could operate that asset at 70% occupancy and still produce cash flow.
Well, we've got our first guest of the year.
Yes, and our first returning guest ever.
Double whammy.
A double whammy.
Double whammy. Well, who do we got today?
Well, today we've got Lonnie Hendry from the TrippWire podcast.
Oh my gosh, that's your favorite podcast.
It is my favorite podcast.
Mm-hmm. Yeah.
Like, I listen to it more than I listen to ours.
Well, I guess you know what ours is going to contain. And you get valuable information from Trepp. Can you explain what TrippWire is and why you listen to it?
I met Lonnie in Denver 2 summers ago, and he spoke to the CCIM instructor cadre there for instructor training. Mm-hmm. And one of our colleagues brought him in, and I'd never heard of TrippWire. And so after that, I started to listen to the TrippWire podcast, which is all about, it's kind of a week in review, like what happened in the CMBS world and the commercial real estate world in that week. And so I remember listening to it for the first time, and they used all these words I didn't understand.
Like commercial mortgage-backed security?
I didn't know what that one meant, but
sure.
It was over my head.
Mm.
And in the commercial real estate world, I'm not used to not understanding what's going on,
right?
And so it was a little bit of a challenge at first to just, how long is it going to take me to listen to some of these episodes before I'm really tracking with what they're saying?
Mm-hmm.
And that happened fairly quickly, like just the learning curve, because, small town real estate, we don't use a lot of CMBS financing. I kind of knew what they were, but when they start talking about the numbers and how it relates to all kinds of things that are going on, it just took me a minute to kind of learn their vernacular.
Oh, yeah, sure.
But now it's like...
When you say they've got 3 hosts, is that right? That all specialize in something?
There are. And so, Lonnie, tell us a little bit about...
Lonnie, welcome back.
Yeah, Lonnie.
I guess, we should ask you about TrippWire.
Yeah.
Yeah, I think Bo is doing a great job. I mean, like we do a week in review podcast. It comes out every Thursday, so we record it live Thursday. Haley, our producer, does some editing. We release it Thursday evening, and we haven't missed a week since we started in March of 2020. So we're 240 episodes in.
Wow.
They're all 45 minutes to an hour. We've had a couple iterations of people on the podcast. Now, in our most current version, it's myself and my colleague Stephen Bushbaum. We're the 2 co-hosts, and then Haley Keene is our podcast producer. Additionally, we'll run like some guest podcasts on Tuesdays, and so we usually have maybe 2 guest episodes a month, and we'll try to bring people in that are relevant from the CMBS or CRE markets, and those are more either deep dive or specialty focused based on who the guest is. And so, it's been a great time. It's a highlight of our week. We love the interaction. We've really got some loyal listeners and followers, and it's really opened up some great opportunities for us to be involved in other events and do live podcast recordings and other things. It's been a really, really great time.
At the end of their episodes, they do these shout outs. And so if you interacted with them online or sent them an email or whatever, they'll give you a shout out. And so I've had a few shout outs in episodes.
That's a great idea.
As
a matter of fact, if you're watching this right now on YouTube, you give us any comment at all, you get a shout out on the next episode.
Let's just totally draft off TrippWire.
Yeah, sure. I'm sure they came up with that idea. Shout outs.
It's interesting though, because people love the shout out, and it really does help the engagement, because it just makes people realize that we're relatable and we really are taking feedback and learning from people that are in the marketplace. I mean, we have access to a lot of the data that practitioners use in their day-to-day workflow. And so we have a specialized niche in the market, and I think we're really good at tapping into that, but we're not doing deals. We're not out there buying and selling or underwriting or are lending money against properties, and the people that are, when they reach out to us and kind of share their perspective or deals they're working on, it really just brings our whole podcast full circle. And so we definitely want people to know how much we appreciate them listening and participating, because it makes our end product better. And without them, it would just be a bunch of folks talking about CRE and using words that Bo mentioned that may not be familiar with them. And so it's good.
I know what you mean, because Bo will send me emails he'll get from time to time, or nearly on a daily basis, I'd say, of people writing, just sending appreciation for the podcast. And it's so true. It gives you a little extra oomph of excitement every time you go in to do it. So what were you going to say?
Well, I just thought we'd maybe transition, to what we want to do on our podcast here.
Yeah. Oh, yeah. Right. So we have a commercial real estate podcast, Lonnie, where Bo teaches me everything he knows. You know all that. Let's recap real quick, because last time we had Lonnie on, we talked CMBS loans and the state of the market, and that was nearly a year ago.
It was nearly a year ago, and yeah, if I remember, Lonnie actually offered you a job at the end of the episode.
Yeah, he definitely did. Yeah.
Listen, he's not only did he pass the test at the end of last podcast, but he retained that knowledge. He threw out the commercial mortgage-backed security when you use the acronym. Like
that's right.
He's starting us off. He's starting us off hot.
Yeah. Mm-hmm.
So I was listening, to the TrippWire podcast, the latest episodes, and I kept hearing this term that I haven't really heard before. And so I wanted, Lonnie, to get you to address this term, unpack it a little bit, and then maybe just sort of lead us into our conversation. Because what I'd love to hear from you today, and really for Timmy's benefit and mine and our listeners, is get a feel for what we're looking at in 2024. But this term that I heard was immaculate disinflation. How about that?
Wow.
Immaculate disinflation. Which, when I hear the word immaculate, I think of two things: Catholicism. Yep. Oh, yeah. And the Steelers. There's this famous catch from was it Lynn Swan or?
It was Franco Harris.
Franco Harris,
and it was the Immaculate Reception.
That's
and
right.
That's exactly when I hear the term. That's what comes top of mind. When Stephen was using that term and Haley last week, I just kept thinking about the Pittsburgh Steelers, the terrible towels and everything associated with that. But
that's football, by the way, Timmy.
Football. Thank you. No, yeah.
Didn't want to leave you in the dust.
Super Bowl's coming up.
Yeah. Okay. Good. Okay.
There you go.
Cool. So what is it? Immaculate what?
Immaculate disinflation. And I'm going to let Lonnie explain to us.
Look, I'm fairly simple. I'm not super complex. So my definition here is not going to be too deep. I mean, the reality is, as you guys know, over the last 2 years, we've seen a pretty strong inflationary environment where inflation rates were high, CPI was high. The Fed had to take, dramatic action. They raised the federal funds rate 550 basis points over a 15-month period to try to get inflation under control. And generally, the consensus was heading into that, once the Fed started making significant moves, was that we were going to see some hard landing or recession or this negative impact to the broader economy.
Okay, let me stop you real quick. That's another term I hear a lot, and I think I understand
negative
what
impact.
It means. No,
I can explain that.
I got that one. Like hard landing versus soft landing, but I've never heard anybody really explain like, what's the hard landing actually look like? What's a soft landing actually look like? What are we actually landing?
Yeah, all good. Yeah, good questions. I mean, I think hard landing would be what we saw coming out of the great financial crisis in 2008. Massive unemployments, no liquidity, deals can't get done, people are losing their homes, foreclosures are rampant, everyone's struggling just to get by, there's more months than money type of scenario, right? That's hard landing. That's what nobody wants to see. But that's what everyone was afraid of because the Fed's action was fairly unprecedented. I mean, the amount of rate hikes, the overall percentage of rate increase in the relative short period of time was unparalleled in recent history, right? And so soft landing would be they take all these corrective actions, you see inflation come back into what they want in their target range of 2%, but you don't have any of those after effects of recessionary environment, job losses, foreclosures, et cetera. So like the soft landing would literally be taking an airplane, coming down, where you don't even feel the wheels touch the ground, and next thing you know, you're stopped and parked at the terminal. Whereas a hard landing is something where the luggage things open up and bags start flying out and people are screaming and all of that, right? So this immaculate disinflation
Makes sense.
really is just another way to describe a soft landing, where you're threading the needle, the economic needle, between hard landing, soft landing, and you're effectively like bringing everything in place at a level that's just unprecedented, not expected, very difficult to do. It's some sort of divine intervention or immaculate disinflation where you're getting the results you need, but without any of the negative consequence. And it appears, at least today, that we're more likely for that type of scenario than we are a hard landing. Now, the caveat to that is the unprecedented moves from the Fed, in my opinion, haven't fully been felt across the economy, right? So we've seen a lot of mortgages on the CRE side that have maturity dates in 23 or that are upcoming in 24 that have gotten extended or modified, or they've had some sort of non-traditional maneuvering done with them. Potentially that works and the market just kind of plays itself out, but there's a chance that we start to see, just this week, unemployment, our layoffs have spiked. I think probably 10 or 12 companies, notable companies, have laid off some double-digit percentage of their workforce. UPS announced yesterday 12,000 workers being laid off. If we start seeing that domino, I think the discussion of recession, hard landing comes right back to the forefront.
And that was this week.
Yeah, so this week, there were several. American Airlines announced 1,000 employees. UPS announced a bunch. PayPal announced some more. There was 10 or 12 notable companies that had somewhere between like 8 and 15% of their workforce that they were laying off. And I think the risk we have there is just that can become systemic. A lot of companies don't want to be the first mover, but if you see people in your space, laying 10% of their workforce off, it probably gives you a little bit of leeway to start making some of those moves yourself. And if enough companies do that, then consumer sentiment shifts, and then it becomes prophetic at that point. Like people start believing the hype, and next thing you know, we're in a recession.
Our father has been on a regional bank board for 30 plus years, maybe even longer. I don't know how long. Pretty much my entire life. I never remember him not being on this board. And I remember him talking one time. He was explaining to me, like, if they have a bad quarter, if it's already going to be a bad quarter, that kind of gives them the cover to go ahead and realize some more losses. If it's going to be bad, let's just go ahead and let's own it, and let's try to get all the bad stuff into this quarter so we can start next quarter clean.
Like instead of trying to fight it, you hold its hand and walk with it, kind of thing. Like what we should do with anxiety.
Yeah.
Okay. Yeah.
I think people like. Nobody wants bad news, right? And nobody wants a down economy or down market. But bad news is usually a dish best served warm. And if you know that there's some headwinds, you shouldn't try to hide them or spread them out over a longer period. You should just take the loss and move on. And I think we're seeing that play out here, where the ramifications of unprecedented stimulus from the federal government coming out of COVID, crazy inflationary environment, Fed taking dramatic action. Up to this point, everything has still remained fairly strong and stable. But now I think to Bo's point, like if you know things are going to go bad and 4 of your competitors are acknowledging that it's bad for them, you might as well jump on that train and say it's bad for you and get that over with. And then hopefully the market stabilizes and everyone emerges better. But the challenge is just that it's not usually contained. What we've had in 23 was we had a lot of layoffs, sizable layoffs, but they were with tech companies. So it was really just the tech sector that was feeling the brunt of the layoffs. It didn't really spread to service industries or other employers, but it appears in 24 at least that it's a little more widespread, where you're seeing banking institutions, technology companies, service logistics providers, all feeling some form of pain where they're laying people off.
I'm sorry to cut you off. Did you finish your thought pretty much?
Well, yeah, just basically what Lonnie was saying is, if you're FedEx, say, and you see UPS lay off a bunch of folks, and you need to make the same call, but you were just trying to hold out, it's almost like their announcement gives you the cover to do the same thing.
Right,
and it's not such a blow.
Is there a common thread between these layoffs that we saw this week Because it does sound like, you got PayPal, UPS, American Airlines, all very different companies. Is there like a common thread as to why these happened so close together? Does that matter?
I think I don't know necessarily that there's a common thread other than just there's been downward economic pressure on all of those industries for some time. And I think it's almost one of those things where we're in the first quarter of this calendar year. It's January. If you're going to make some headlines negative, you would probably want to get them out now so that you can finish the year strong and kind of reset. And I think the interesting thing too, and I'm not an economist and I haven't studied any of these companies in detail, but I know a lot of them ramped up hiring during COVID. Like when everyone was work from home and the market was booming, they inflated their employment figures and brought a bunch of people on. So some of this could really just be right-sizing their firms because they overhired. But, I don't know. It'll be interesting to see. Retail earnings generally have been pretty strong the last couple of quarters. There's some broader macro geopolitical stuff going on with the Red Sea and shipping containers being taken over and some challenges with that, and what's going to happen with cost for shipping could disrupt the supply chain. So some of these might be preemptive, right? That they're seeing some storm clouds brewing and they're just taking proactive. But I would suggest it's probably just timing is good for them to make some moves and then recover by the end of this calendar year.
Mm-hmm. That makes sense.
Well, let's do this, if you don't mind, Lonnie. Let's step back a little bit and, from where you sit with the data that you have access to and how you guys cover the markets, like what do you think we're looking at in terms of just broad strokes, 2024 commercial real estate? We heard the Fed say that they're going to have some rate decreases this year. Like, what's your take on what 2024 is going to look like for commercial real estate in general?
Yeah, I think 2024 is set up to be a decent year. I think 23 was really challenging because there was so much uncertainty. Like, the one thing I know about commercial real estate is you can operate in high interest rate environments. You love operating in low interest rate environments. The part that's difficult is when buyers, sellers, lenders, borrowers don't know what to underwrite, or they don't know what interest rates are going to be, or they don't have certainty around certain market characteristics. It puts some really challenging times in front of them. And 2023 had all of those ingredients, where you had unprecedented rate hikes, economic uncertainty, geopolitical, global challenges, all in 1 year. And so it was really kind of a pullback. So we saw transaction volume in 23 down by 70% compared to 22.
Wow.
Lending, new origination was down very similar. So 2024 sets up to be better than 23. The Fed, as you mentioned, has come out and said, hey, we think we're going to see the opportunity to potentially lower rates. That creates a psychological stigma that's optimistic, that people are more optimistic around just the general narrative. It doesn't erase, though, some of the challenges where you have a lot of properties that transacted in 2020, 21, first half of 22 at really, really high prices on really low cap rates. Part of this inflationary challenge that we've seen is expense creep across the spectrum. So regardless of property type, operating expenses are significantly higher today than they were 2 years ago. So you have these components where even if the Fed cuts rates, call it 100 basis points or 1%, and your loan's coming up for maturity and you bought a property 5 years ago, you're still having to refi. Even though the rate's lower in 24 than it would be in 23, it's still significantly higher than it was when you took out the loan. So the value diminution hasn't been realized. So I would say my general consensus on 24 is we're going to see more activity, greater sense of optimism than we did in 23. But I think practically, you're probably looking at maybe a 20 or 30% uptick in volume and origination and transactions from 23 to 24, which is still going to be, on a relative basis, a down year compared to what we've seen over the last 5 or 6 years.
And other than office, like we understand office is just hammered. I think that's the technical term for what it's experienced right now.
It is, yeah.
Hammered.
I'm acting out hammered.
Okay, because that sounded like a hiccup to me.
Yeah, which someone who's hammered often hiccups.
Oh.
I was playing drunk.
Yeah, I'm with you now.
Oh, okay.
It just took me a minute.
Yeah.
When I said hammered, I was thinking crushed.
Right.
Like not.
Right.
Okay.
And my ADHD brain went to drunk. And so here's my impression of offices. See, that's so we can get
There it is.
yeah.
Yeah.
That's it. Yeah.
I was waiting for the half cross eye to happen. That's what I was waiting for.
Yeah.
Yep, that's good.
The whole trick is to look at somebody's ear.
I didn't know that.
Yeah, that's how I've always played drunk. You look at somebody's ear and just kind of barely sway. And it's like when you hang out with somebody where you look in their eyes and you don't see their soul, Yeah. It's because they're like looking right at your ear. Old acting trick. Okay. We'll save that for my podcast.
Okay. Done.
Anyway.
All right, back to the question. What other what's your take on the other asset class, the other property types? How are they looking in 2024?
Yeah, I mean, broad brush, retail really strong outside of regional, super regional malls, which we all know the challenges they have. But if you look at neighborhood, community style, like shopping centers, incredibly strong. We've seen transaction volume on those pick up significantly and sales prices that are, at or above historical norms. So I think we'll continue to see that. We've been kind of framing it as a retail renaissance. So I think if you survive COVID, 2024 should be a really great year. That market has been strong. Hotels, interesting. Like they're pushing the envelope in terms of all-time high RevPAR, ADR type of numbers, occupancy numbers. But a lot of that is built on business travel and people still catching up on their leisure travel that they missed out on when they were locked away for a year.
What's ADR?
At home. Average daily rate.
Okay, thank you.
And RevPAR.
And then RevPAR is revenue per available unit. So those are just some hotel terms. And so a lot of times you'll measure competitive set or you'll measure comparability looking at properties ADR and RevPAR. So that gives you a sense of, is this property comparable to another property that I'm trying to do some analysis on?
Gotcha. Thank you.
So hotels are strong, and I think they'll be strong in 24. Conferences are back with a vengeance. I think the fear of people doing conferences is gone, and so hotels have been really strong. Multifamily is an interesting one. I think, holistically, multifamily is probably still the most, if not second most desirable asset class, maybe behind industrial. But you are starting to see some distressed pockets and some potential like over-levered floating rate deals start to have some challenge. But I think it's contained, it's not an inconsequential number, both in terms of properties and like appraised value and loan balance, but it's not enough to bring the entire sector down. And for the most part, multifamily is going to continue to do well. And then industrial, data centers, those type of properties, like still flying off the charts. I mean, rent growth that's unprecedented, appetite that seems insatiable. So I would say, generally speaking, outside of office, the market looks pretty good. The challenge will just be that bid-ask spread where someone paid X 2 years ago. They want to sell now, but they can't get what they paid for it. Are you going to see people, capitulate and prices come down to where you can transact? Or is there going to be this continued like gap between what buyers can pay and what sellers are willing to accept?
What about, or do you have any questions?
No.
Okay.
I just remember a lot of this from last time we talked, right? So I'm just thinking about where it was the bid-ask spread, kind of in the same position here, what's going to look like, and B, are people going to, I'm just restating what was said now. So,
okay.
Yeah. No, I'm good.
Good. All right, next question then. How, will you explain to us a little bit how
I did have a question. It's real quick. Hotels, what asset class is up? Is that its own asset class? Hotels?
Yes.
Yeah.
Hotels is its own, but it's then broken down into a couple of distinct types. So you could, depending on who you're talking to, either limited service, full service, resort style, You also could throw extended stay in there. Some of them will use terms like select serve, et cetera. But really you have like your Courtyard Inns, your Holiday Inn Inns, your Hampton Inns that are kind of like your limited service. So what that means is probably 90% or so of their total revenue come from just the rooms themselves, right? People renting a room for a night. They have some ancillary services, maybe a small concession area or something else that drives a smaller, sub 10% percentage of their overall revenue. You have full service hotels where They have banquet space, conference space. They probably have, somewhere between 50 and 75% of their revenue from rooms, and the other components are from food and beverage, restaurants, rentals, etc. Then you have like resort style hotels that, a large portion of their revenue is outside of the traditional just rooms themselves. And then on the extended stay, obviously, it's a different type of thing where it's not really like an apartment, but it kind of operates like an apartment because people are generally leasing space for a month or a couple of months at a time versus like on a night by night basis.
You see those in motels?
Yeah, so like motels might go the other direction where people are renting, like
by the
maybe
hour
less
or
than
something.
even a night.
That's the other one.
Right.
Extended stay, you might have like an actual kitchen.
Yeah. Okay.
Right.
And they're like a small kitchen, like you can actually use it like an apartment.
Yeah.
Sure. When Autumn and I take Maddie on these, softball weekends or whatever, when we stay in these hotels, like oftentimes there's a little fridge.
Yeah.
It's not like we're going to go to the grocery, stock up, cook meals kind of thing. Some of these extended stay places have that kind of functionality. There's actually like a range in there. You should actually do some limited cooking. There's at least a small full-size refrigerator, and
cool.
You might actually spend days or months or
Gotcha. Gotcha. Okay, cool.
Yep.
We can move on from that. We never talked about hotels or that ever being an asset class in CRE. So that's new information for me.
Yeah. Well, when we talk about the 4 food groups, hotels are not one of the 4 major food groups.
Yeah. Okay.
It's kind of the next one.
Sure.
It's certainly its own thing. We did an episode, Lonnie, a couple months ago where I was trying to explain what was going on with interest rates and that kind of thing. But would you share with us how you would explain how commercial real estate rates are tied to the 10-year treasury? Like, what is that relationship there?
It's not a direct correlation. And I think that's something that people have to understand is that if the federal funds rate goes to X or 10-year treasuries are at Y, it doesn't by definition mean that you're going to see cap rates, as an example, go up or down by the same percentage. There is a loose correlation in the sense that as the cost of capital goes up, right? And people are looking out, on a horizon, whether it be 6 months, 1 year, 10 year, et cetera, that cost of capital does get distributed to people's purchasing power and transaction velocity and volume, et cetera. So what we've seen is from a mathematical cap rate calculation perspective, there's a couple ways you can convert this year's income into a valuation. And like one method is just doing a direct capitalization. So you take a single year's net operating income, you divide it by a cap rate, and that gives you a value, an indication of value. That cap rate can be comprised of a couple of different ways. Like one, you can look at other like type properties that have recently sold, take the sales price, take the NOI at the time of sale, and you can calculate mathematically a cap rate. What did that investor pay for the property for that NOI? Therefore, here's the outgoing cap rate. You have like a build-up method where you can look at the 10-year treasury and you can say, here's what the risk-free rate is, whatever the 10-year is, right? Here are some other components that go into building up a cap rate, and you can calculate a cap rate that way. Or you can do like a band of investment method where you look at mortgage and debt and you apply different triggers to that. So mortgage is 70%, equity is 30%. You do a band of investment calculation and you come up with a cap rate that way. So the 10-year plays a role in how banks look at, what they can lend at, what their cost of capital is. That gets transferred into what borrowers have to pay. And then if you look at the cap rate scenarios, like it is a component in a certain type of method where that risk-free rate is considered. There's just a psychological stigma though. Like right now we've seen it. If the 10-year treasury at this point has, every time it's gone above 4% and as it's approached 5%, that's very negative correlation to sentiment around CRE. Anything sub 4, we've seen the sentiment be somewhat optimistic, right? And so I think it's more just kind of a bellwether than it is truly like mathematically impactful for like day-to-day operations. Now, some people that are more technical maybe have like a deeper thesis of why that really is impactful, but it seems like in today's environment, anything that's under 4%, sentiment seems to be like, all right, it's risk on. We're ready to start doing deals. When it starts, going above 4 into that 5 range, it's like, all right, there's probably some broader stuff on the horizon. We need to be defensive.
If you are one of those listeners right now that knows that more, let us know in the comments. It'd be very, very helpful.
You mean one of the people that has a deeper thesis?
Right. Yeah. Like one of the people he was just explaining. That's like,
It's the first time in my life I've ever said deeper thesis.
How'd it feel?
I heard that. Every time I talk to Lonnie, I get new terms
Yeah.
that I can throw out there. So I'm plugging deeper thesis into the brain there to use later on.
I'll show you a deeper thesis. That would be on my Tinder profile if I had one.
Well, what questions do you have?
I don't have any at this moment. It's like, I guess my question would be, if you're in commercial real estate, right? Like a lot of our listeners, or you're looking to invest, this simple question, is 2024 a good time for me to invest in one of these asset classes?
Can I reframe that question?
You absolutely can.
Okay. I completely believe that in every market cycle, in any market, there are opportunities.
Yeah.
Like there are good opportunities.
Mm-hmm.
If I'm right about that, then Lonnie, I would be interested to hear in 2024, where do you think the pockets of opportunity will be?
There it is.
That's what you meant to say.
Yeah, that's great. That's so good. And for anybody that doesn't know about market cycles, you can check this out after this video right here. So good. Bo delves into it so well. Boom. Lonnie.
So I think, your framing of the question, Bo, is spot on. And I agree. I think 2 things I've been on record, and I'll continue to be on record, whether you take one of my classes or you listen to our podcast or you talk to me on the street, real estate by definition is cyclical. Real estate by definition is local and sometimes hyper-local in its activity, right? So market participants can make and find deals in any market cycle, any part of the cycle. What transactions are driven by a lot of times is information asymmetry. So one party knows more about the asset or more about the market or more about what's coming online than the other party does. So you can see upside that maybe the broader market doesn't see, understand, know, et cetera. So in this cycle, especially in this cycle, I think in the down cycle, there's actually more of those dislocated type of opportunities where somebody can come in, find opportunities with information that they may have that others don't, to make themselves really profitable or set up for profit in the future. So with that end, I would actually be a little bit contrarian and say a lot of these offices that are located in top 5 gateway cities, they're probably getting to a point where that cost basis on entry is low enough that you could operate that asset at 70% occupancy and still produce cash flow. And if you can figure out a way to get it back to 90% occupancy, then you can make a whole lot of cash flow. And then at some point when the market comes back, you're going to be set up for a really nice payday. Now, again, it doesn't apply broad brush that all a distressed office is a great buy. But I think, if you look at San Francisco, LA, Chicago, I'm not betting against those cities 10 years down the road or 20 years down the road. I think those cities are going to be back to being dynamic. I think people eventually come back to the office. So I would say there's going to be some opportunity in select office in select locations. Multifamily is another one where you had a lot of speculative investment towards the end of the cycle where people got a little bit out over their skis. They borrowed too much money. They couldn't actually execute on the value add plan that they thought they could. And so there's going to be an opportunity to come in, in a fairly sizable number of those deals and potentially buy the asset, for the debt or maybe less than the debt and really generate some upside if you can actually execute on a value add plan. And so, I think those are 2 kind of traditional. I think if you look outside of that, there's going to be some opportunity in some of these other asset classes just based on market disruption. So we talked a little bit earlier about retail, having a renaissance. There are still a lot of mom and pop operated strip centers and neighborhood centers that probably have leases that are below market, especially given the run up in rental rates. And sourcing those deals, finding those non-institutionally owned assets in good locations are going to provide some real upside for people that can execute.
Which you're really good at, Bo. Or that's your experience would be that right there.
Well, we've done two group investment deals over the last couple of years that were buying mom and pop owned strip centers with below market leases and doing exactly what he just said.
Right.
Yeah. That's worked really well. I want to get back to office though. Yeah. You mentioning office, if you can buy it low enough, essentially, you can potentially make it work. And with all the disruption's not the right word, but with all the problems with office in the San Franciscos and the Chicagos and LA, it's looking like you can start to buy at those kind of rates. There's this building in Louisville, Kentucky that used to be, I think we used to call it the Hilliard Lines building. It's the 500W building. And do you know the story about this building, Lonnie?
I don't.
Okay.
I think it's in our data. I think we may have talked about it, but it doesn't, like the nuance doesn't jump to the top of my head.
I'm probably 70 to 80% correct in the details of this story, but it's a good story, and I think it illustrates his point. These guys, whoever owned it, they sold the building, and these Ukrainian guys bought the building. So foreign investment dollars came over, and it turned out that the folks that bought it had embezzled the money from the Ukrainian National Bank, and the federal government here froze all their assets.
Oh.
And so the guys who sold it bought it back for about 20 cents on the dollar.
Oh.
Now that I may not have that right, but they bought it back really low. And this was a B-class building in a really tough downtown market, lots of vacancy there. But they bought it back so low that they had the ability to do some pretty incredible renovations. The whole fourth floor now is a pure amenities floor for the tenants. So there's a fantastic gym. There's a golf simulator. There's a huge training room where we hold our CI, our CCIM courses when we give them in Louisville. We hold them there.
Wow.
There's a mezzanine. You can go outside and look over downtown. There's a conference room and a small meeting room. And then there's this like just big space that has a bar over on the side and a whole wall of whiskey lockers, basically. So all the tenants have lockers where they can put their own stash in there. And it's just a floor to serve the building. It takes the building up in class. They completely redid the lobby. It looks like a world-class lobby when you walk in. It still looks the same outside,
Yeah.
But, man, when you walk in that building, you're thinking, whoa. And the reason they were able to reposition the building like that is because they bought it back so cheap. So last week I'm teaching 102 in Tucson, Arizona, and I've got this girl in class who's from Moldova. You know where Moldova is? You know where Moldova? I didn't know where Moldova is.
Mm-mm.
So she told me she was from Moldova. It's like an Eastern European country. She's got the cool accent, and I'm telling her this story in class while we're teaching through the office module.
Yeah.
And when I say these Ukrainian criminals, I'm looking right at her.
Oh,
just coincidence. I'm scanning the room teaching, and she goes, "Why are you looking at me?" I can't remember the last time I was embarrassed. Like I turned beet red. The whole class just melts down. There's like 36 people in there. They just melt down. And I'm thinking, A, I don't think you're Ukrainian. And B, I don't even know where Moldova is.
Yeah.
But it's 2 hours away. So like they would vacation in Ukraine. And she says she gets mistaken for a Ukrainian all the time.
Sure, I guess
stuff.
that.
And
Yeah.
this girl was incredibly quick-witted. I mean, right when I said Ukrainian criminal, I just happened to be looking at her, and I was. And she was like, "Why are you looking at me?"
Yeah.
I mean, it was really well done.
That's great.
Funny. You would have been proud. But
Now, Eastern Europeans, they're quick. And they don't care either. Like in the sense of, they'll just say it.
you're right.
Right? They
She
just
did
say.
not care.
Yeah.
She threw a couple of zingers out like that throughout the week. She was
Yeah.
a lot of fun to have in class. But anyway, that's kind of an example of like, if you can buy that low, and Lonnie, would you agree? Like that's kind of what you're talking about. There's going to be those kind of opportunities.
So it's look, none of this is earth shattering in the sense that regardless of where you learned about real estate or what level, you'll most of the time make your profit on the front end. You buy it right, and you set yourself up for profitability into the future. And in this instance, there are some nuances to it in the sense that you're going to have enough capital not only to buy the asset, but also potentially operate it at that really low occupancy or whatever for a couple of years until you get it fully repositioned. But yes, like if you can buy them right. The other thing I think that's interesting, and I haven't really talked about this on our podcast or broadly, but I'm becoming more and more convinced that we're going to start seeing office buildings be branded like hotels are. So we've seen like the hotel lobby amenity package starting to be seen in office buildings.
Mm-hmm.
I think there's going to be some real opportunity for some of these people that have name recognition, to experiential type of real estate. If you can start branding your office as some really 5-star resort type of office, and then you have the amenities that coincide with that reputation, it's going to really draw people back to those spaces. And so we've seen it in the retail space where the mall operators have really gone to more like an experiential type of experience or retail experience. And I think you're going to see something similar in the office space where marketed correctly, positioned correctly, if you can get the cost basis where it needs to be, then you rebrand as some really hot, trendy, amenitized type of space where people have that name and recognition. It could go a long way in driving people's desire to come back into those spaces.
Yeah.
Yeah, and that's exactly what they did with that building.
Yeah.
Like
Makes total sense.
it's now branded the 500W building,
Yeah.
which is their address, but like it's cool and it's memorable. The lobby has a restaurant and a coffee shop, and it's just vast and spacious and beautiful.
Yeah.
And there's a lot of seating areas. Almost looks like like a big WeWork, co-work. I mean, there's not desks and stuff, but there's all these seating areas and stuff, and it does look a lot like a really nice hotel when you walk in there.
Right. That would bring people back into. It all makes sense. Why is the letter W such a strong letter?
Lonnie?
My middle initial is W, so I'm kind of partial to the W myself. But
And my first one.
Yeah, it is. It's maybe because our capital is Washington, D.C. Maybe there's some tie to our first president in Washington. Like maybe there's just some historical context. But yeah, it is interesting how it definitely has a prominence when displayed or talked about.
Yeah. If you're listening to this right now or watching this on YouTube, let us know why you think W is such a strong letter. Anyway, are we doing a pop quiz?
Oh, yeah, I was about to suggest. You want a pop quiz? Lonnie, you up?
Yeah, let's do it. Yeah, let's do it.
Baby.
All right, so Lonnie, like last time, I'll give you the first shot. We give Timmy 5 questions. We see how well he's been paying attention. I've been seeing the pages of notes he's been taking. So we'll alternate through 5 questions, and as our guest, you get to go first. What do you got?
All right. So this, Timmy, you should know this one because you kind of drug the question out of me, or the answer out of me with your question. Give me a breakdown of the different types of hotels that fall under the hotel segment. I had described maybe a couple of different types of hotels. What were those?
Yes, one was full service hotels. One was partial service or half service or sub service.
Yes,
Limited service
or select serve. Yeah, there you go.
Limited service, extended stay, resorts.
Very good.
Was that?
Yeah,
That's
you're
it,
on
man.
Yeah.
Bam. Ha. Nicely done. Nice question.
Okay, let's see. When Lonnie was sharing with us about the 10-year treasury and kind of how it impacts sentiments, he actually used the phrase the risk-free rate, which is kind of the idea of what the 10-year treasury is. There was a particular rate he mentioned where if it's above that, sentiment seems to be negative.
Yeah.
And if it's below that, it's kind of like
4 to 5%, it's bad. Under 4%, optimistic.
I would say that's a correct answer, right? That 4%.
Yeah, he's on it,
If it's above 4%, approaching 5%, there tends to be a
Bad sentiment.
pull back, wait and see kind of thing. And then, okay. Hey, hard to stump Timmy.
Come on, give me something hard.
All right. So, this one will be difficult, I think. Okay. I said when I was talking about the 10-year treasury and I devolved a little bit into cap rates, I said there was a certain type of methodology you could use where you take a single year's income and you divide it by a cap rate, and that gives you an indication of value. There's a certain type of income approach, and I listed it by name. Do you remember
Direct
what that was
capitalization.
called? Yeah, there you go.
Man, there's a lot during that time. I was like, he's speaking so fast, I'm not going to be able to get these down. But that was towards the beginning of that. All right. Yes. Mm-hmm. Yeah.
All right.
And that would be contrasted with the discounted cash flow or yield capitalization, which effectively is the same process, but over a projection period or a hold period. And then you discount those cash flows back to a net present value. That's how a lot of people will, if they're acquiring a property, they'll do like a 5 or 10 year DCF. But a lot of times, if you're just trying to get a feel for what is today's value, you just do a direct cap method.
Sweet.
And you know net present value.
Yeah, I know net present value. I do. Yeah.
You do.
Yeah. Yeah, I do now. We're 43 episodes in now, Lonnie. I think when we talked to you, we were like 4 or 5.
Yeah.
Yeah, so
I think you're probably a candidate for CCIM at this point. I don't even know it. You're holding out on me.
I'm pretty sure he could pass 102.
I'd get the absorption questions right. That's for sure.
That's great. That's great. I'm going to try to get something specific and a little bit harder because you're nailing all of these. Lonnie's prediction for 2024, he talked about transactional velocity being up over 2023 by a certain percentage range.
Yeah,
What was that?
30%? Because it was down 70% last year.
That is correct. All right, Lonnie, this is the 5th question, and Timmy's making us look bad, okay? So I want you
Making you look good. You all explained all this really well.
Okay.
Yeah.
I want you to dig into your bag of tricks and come up with something challenging here because I haven't been able to do it.
So, as much as I'd love to like stump him and come up with a challenging question, I actually would be more excited to hear him give me his interpretation and explanation for Immaculate Disinflation, since that's where we started today.
Okay. Great. All right. So, Immaculate Disinflation. Essentially, in the simplest terms, means soft landing. You're not seeing all those layoffs and foreclosures or all the bad things that we saw out of the Great Recession in 2008. So what we're seeing now is an immaculate disinflation where not much has been affected so dramatically. Kind of like an airplane softly hitting the ground.
Softly hitting the ground?
Yeah, softly landing.
Okay.
Yeah, softly. Yeah. Softly landing. Then a hard landing where it hits the ground, right? On wheels, you're safe, but the luggage might fall out of the. Mm-hmm. Right.
Yeah, I think you nailed that one too. Okay, so follow up on that.
Okay.
That. The bonus question, bonus round.
Okay.
We didn't really talk about this, but I'm sure you guys have talked about this, or you maybe have heard it. The Fed stopped raising rates because they felt like inflation has reached near their terminal or like what they want the inflation number to be. Like, what is that target inflation range from the Fed?
Like in points?
Yeah, so it peaked at about 9%, and then it has steadily come down, but they've been
So it was up around like
steadfast.
550 basis points. Is that right?
Yeah, so that was the federal funds rate. That's the action the Fed has taken to correct the inflationary environment.
Oh,
But the inflation rate as reported by like CPI or PCE, like what is that target inflation number that the Fed is trying to achieve?
And it is a percentage.
If they see that, it is a percentage. If they get to that number, that will facilitate them lowering that federal funds rate that they've spent the last 18 months raising. But they have a target number in mind that they're trying to get inflation to.
right. This is a total guess because I have no clue. So you stumped me. Good job on the bonus question. But, I'm not. I haven't been wrong yet. So my guess would be 4%?
Or maybe even half of that?
Half of 9? 4.5?
Targets 2.
Oh, target's 2. It's at 9%?
It
was at 9.
It got up to 9%.
Yeah.
Okay, target is 2%. Okay.
Yes.
All right. Yeah, I don't think we have talked about that.
I don't think we have.
Or in those terms, at least.
Okay.
So all the moves that they've made is to try to create this immaculate disinflation to get inflation down to this targeted 2% that
Correct.
they would say is healthy for a growing economy, but
Not crazy.
Yep.
Yeah. Okay, cool. Sweet. Sweet. Yeah. Anything else?
Yeah, I mean,
Nicely
this
done.
is this has been a blast. You guys are great, and Timmy, I think we got to get you licensed. If you don't have your license yet, man, you got to get that license, because I think if Bo could bring you on his pitches, your charisma is going to help him win more deals, and your knowledge is solid now. Like you're legit, man.
It's getting there. It's getting there. Yeah. Thanks, Lonnie.
I would
Thank you
agree.
so much. Yeah.
Now, Lonnie, before you go, give us some ways that our listeners can connect with you and Trepp. Like I know, of course, we've talked about the TrippWire podcast, which is, Friday morning listening for me most weeks. But you guys do webinars. You got a newsletter. Tell us a little bit about how folks can connect with you and Tripp.
Yeah, so if anyone wants to get with us in the email form, they can just email podcast@trepp.com. And if you wanted to, you could request. We just launched a new daily CRE newsletter about a month ago called The Rundown.
Oh.
And it's super easy read, 10 or 12 minutes a day, but it gives you a lot of insight into leasing, sales transaction stories, like actual deals being done. We cover the entire U.S.
That's great.
We'll have about a 3 or 4 minute, intro that kind of gives some just macro sentiment on, topics of the day, and then some really good transaction data. So they can definitely request that. We can get them signed up. One thing I haven't mentioned yet, but I'm an advocate for people that want to know more about real estate or get real-time news. And Bo, I know you're a proponent of this too, but if you're not using, X, which was Twitter, for your CRE knowledge gain, data dumps, et cetera, like you're missing out, because it's constant 24/7 news feed, practitioners that are practicing all across the U.S. that have specialty interest in mobile homes, self-storage, car washes, whatever, you name it, they know it. And it's a really great way. So if you wanted to connect with me on there, my handle is just @Lonnie_CRE. So LONNIE_CRE. Love to connect with you there. Try to put out some content at least every day. So yeah, we'd love to interact. And I think, as you guys know, there's synergy in this space. And so we'll promote the commercially speaking pod. If you can connect with us on the Trepp stuff, let's do it. The more we all learn together, the better it is for the industry.
Let's do it. All that will be in the show notes if y'all want to connect. Just pop on down there.
And I can tell you all that at this point, we've had Lonnie on the podcast twice. I've met him in person a couple of times. We had him come and do an event here in Kentucky. And so I'd consider Lonnie a friend at this point, and he is just as personable as he seems. He's very approachable. When he says, connect with me on Twitter or reach out, and he really means that, and he engages and he's available, more so than he probably should be, frankly. But man, I really appreciate that about you, and it's been a great benefit to all of us in commercial real estate just to get to know you better. And man, thanks for your time and coming back on the podcast, and we really appreciate it.
Yeah. We love it.
Yeah, I appreciate you guys having me on. I love you guys too. I appreciate it. Always available. I mean, look, none of us would be where we are if we didn't have people helping us along the way and sharing wisdom and stuff that they knew. And so whatever I can do at whatever level to help people, it benefits both of us. I'm going to learn from them and they're going to learn from me. And it's a small community. The CRE community, even though it's national or international, it's a small group of folks. We got to look out for each other. We got to bring the next generation up, and whatever we can do to help with that, I'm all for it.
That's awesome.
So are we.
Yeah, so are we.
Yeah.
So are we.
Love it.
All right. Lonnie, thank you so much. You hit me up at all. We can talk about video and stuff.
Okay, yeah. Awesome, man.
Sweet.
Look forward to it.
All right. Thanks, man.
Thanks,
We
Lonnie.
appreciate it.
Bye, Alice.
Yes. Bye, Alice.
Bye, Alice.
Okay.
Yay! Give us a bye. Give us a bye. Yeah.
That was great.
Yay.